Welcome to Bruegel. We are delighted to have you all here for this conversation about the future of banking. We're going to hear a presentation from my colleague Nicolas Veron. Can you all hear me, by the way? Are the microphones turned on? Yes? No? Maybe? Hello, hello. All right. Today's presentation will be webcast, and I believe when you ask wonderful questions and answers, they will also be webcast, so do enjoy your time contributing to the greater public conversation. We have a wonderful panel here today. Nicolas Veron, my colleague, is going to present his report, and then we have a couple of panelists who I will introduce to you further as we get ready for them to speak, who will comment on it, and then hopefully we will have some time for questions and answers later at the end. My name is Rebecca Christie. I'm a visiting fellow here at Bruegel, and I'm delighted that you could join us in person, that you braved the rain. Thanks so much.
Okay, thanks, Rebecca. So you say my report, but it's not my report, it's our report.
Y'all's.
Exactly. It is a report in a series. It's actually number 22 in a series. A Geneva report on the world economy. It's been there since 1999. You will tell me annual since 1999, that's not 22. And you will be right, there have been some special issues, but not many. The Geneva report is led and coordinated by Hugo Panizza at the International Center for Monetary and Banking Studies in Geneva. It's also supported by CEPR, the Center for Economic and Policy Research, which actually publishes the report. So we're very happy with the partnership, and this report was co-authored, as is about always the case in this series, by several people. What is not always the case is that it's gender balanced. I think we're the first one, except maybe one of the special reports, but which had only 2 co-authors, so we're proud of that. And the authors are Catherine Petralia, who is the leader of Cabbage, a fintech startup based in Atlanta, right? And Thomas Philippon, who is an economist well-known probably in this audience, based in New York at New York University. And Tara Rice, who is now in the Secretariat of the Committee on Payments and Markets Infrastructures in Basel, with, I have to mention it, even so it will create an issue in the panel, very generous help from Sam Tosik, who is also at Cabbage, and frankly, counts for us as a co-author, given how much input he provided in the paper, even so, life being unfair, he doesn't have his name on it, but he's acknowledged in the acknowledgements. So that means that our panel is not really a panel of discussion, because Sam really will act very much as one of the proponents of what we're saying in the report, or at least that's my expectation. Exactly. If you have, yeah. But anyway. So that was a team effort, and I will actually make the presentation on this basis. I will use, I've made relatively few changes from a presentation which Tara has used in the first presentation of this report, which was in London 2 weeks ago. And I also want to give special credit to Tara, because you know how this teamwork is, and there's always an element of leadership, and somebody has to take that burden. And I think it's the view of all co-authors that Tara has done an extraordinary work of making things happen, both in terms of substantial input, but also in terms of project management. And I'm very grateful, as I think my other co-authors also are. So, what's the report? I think most of you have the report. This is the outline. We have only 4 chapters, an introduction, something about banking, something about competition to banks from fintech and big tech, and something about public policy. So that will be broadly the outline of my own presentation of the report, because that's the easy way to do it. So the first chapter is really about banks. Banks are special. They're not really like other companies, and especially modern banks, as they have existed since at least the 17th century, are typically privately owned, not always, typically joint stock companies, not always, but always with a government charter. So the notion of a bank which is not licensed charter or license, we can discuss the semantics, but a bank that's not licensed by government is something that has existed in the remote past, but is essentially obsolete. If it's not licensed, it's not a bank. And so banks have economies of size and scope, especially to engage in large-scale international transactions. But the link to the sovereign is something that is really definitional for banks, at least in the modern age. I'm sorry because the format of the slides has problems with our own screens. So I will struggle with my slides throughout the presentation. So the title here, for example, is "Why do we have big banks?" Not "Why do we have big?" Yeah. Well, yeah, maybe. So the report goes into some exposition of what banking is and what big banks are in modern days, because that's important to understand the possible disruption by new technology-enabled competitors like fintech and big tech, which is really the topic of the report. Banks engage in financing. Some of it is cross-border, international. There's investment banking. There is all kinds of things with asset management. But the core business of banking remains remarkably stable, and it's basically taking deposits and making loans. And we give a number of illustrations of this simple proposition in the first substantial chapter, which is chapter 2 of the report. If you look at the ratio of loans to total assets of banks, it remains very high. The red line is small banks, the blue line is large banks. The orange line is the median. You see that even for the largest banks, more than half of the assets are loans, much more than half of the liabilities are deposits, or actually as a proportion of total assets. So that's even more in the liabilities if you exclude shareholders' equity. So big banks are still banks. Interest income is more than half of total income, even for the very largest banks, even more so, unsurprisingly, for the smaller banks. Non-interest income, correspondingly, is less than half and actually almost negligible for small banks. But even for large banks, it's around 40%, and it's pretty stable over at least recent years, for which we have this data set. So basically, banks are still banks for all the fancy stuff, including fee-based business and all that. They still have a lot of their business model from traditional banking. Actually, 80% of revenue comes from lending and taking deposits and enabling payments from this study by McKinsey. We can discuss the details of definition, but that's the kind of big picture. In terms of scale and scope, so this is a bit the genealogy of the report, not that you have to be interested in that, but initially, the questions we were asking ourselves is, do we still need big banks? And does technology disruption challenge big banks as opposed to smaller banks? And gradually we came to the conclusion that it was better to look squarely at the disruption from fintech and big tech, but we still think this question of economies of scale and scope in banking is relevant. And here's the interesting thing is that if you look at the literature 20 years ago, it was very much about economies of scale and scope are not what they're said to be, and maybe we don't need big banks, and smaller banks can do the job. And you have a lot of that literature cited in critique of big banks, of too big to fail banks, in books like, the reference book is probably Admati and Helvig, The Banker's New Clauses, which was published after the crisis. But actually, more recent studies suggest stronger evidence of economies of scale and scope, especially in terms of costs. Even so, the too big to fail reforms of the post-crisis era could create incentives to downsize, which is the end of the slide. So you see the chart, which is the assets of the top 10 banks globally in global GDP, and you see that kind of uptick in scale from the 90s to the mid-2000s, and then it stops with the crisis, but it remains at a relatively high level. It's difficult to get a clear sense of the future direction of travel, but we think that's relevant to the framing of the issues. Also relevant is issues of market share and market dynamics, so industrial organizations. Again, there is much more detail in the report, so I don't want to spend too much time on this, but basically market shares have become more persistent. Finance, and especially banking, is an area where there is less turnover of industry leaders, so there is more incumbency, for lack of a better word, than in many other sectors. Where there has been change is the last bullet point, the fact that if you look globally, the distribution of big banks has changed over time. Not surprisingly, there was a big a boom and bust in Japan. That's the purple curve here. The orange curve is the Eurozone. The light blue curve is the US. And of course, the red curve is China. So if you look at these four big jurisdictions, you see that the grand total of their shares in total assets of the top 200 banks, which is a good proxy for the entire global banking sector, has changed quite a bit in the last 30 or more 40 years. But those jurisdictions remain remarkably dominant. And actually, you can say, well, that's because that's where the GDP and economic activity is, but it's even more than that. If you look at bank assets to the share of total bank assets compared with the share of total GDP, so that's a way of saying which jurisdictions are kind of bank asset heavy versus bank asset light, you see that these jurisdictions, with the important exception of the US, are all very bank asset heavy in global comparison. The US being the outlier, so the US curve is the light blue, the rest of the world is a thin black line at the bottom. And you can see that these are the only two places where banks which are underrepresented in terms of global banking assets. And the other jurisdictions, China since the 90s, which is remarkable, so way before the credit boom of the late 2000s, the Eurozone consistently, Japan consistently with some fluctuations, the UK very consistently with the pre-crisis boom, and also what we call the next five here, which are Australia, Canada, Switzerland, India, and Korea. They're all bank asset heavy in comparison with the rest of the world and the US, which we think is an important thing to keep in mind when thinking about big banks. Anyway, let's talk about competition because this is the core of our analysis. And we did a little survey with market participants, and again, all the details in the report. And what this survey tells you is that the first area where there is competition right now is in payment services. So that's where FinTech and Big Tech are making inroads. Probably not a surprise, but interesting to see it illustrated that way. But if you look forward, there is a certain scaling of other areas of core banking business where competition is expected from FinTech and Big Tech. So that's, I think, one of the big takeaways from our surveys. There's a little bit more. Again, I encourage you, and that's my leitmotif, to read the report. But obviously, the competition is very much in the news. Here are just a couple of clippings on how, the media attention, certainly, but not only from media, also from policymakers and from bankers, the very high degree of attention of about the competitions that FinTech and Big Tech are providing, seen from the core banking business. So I would say the analytical core of the report is really about analyzing those competitive dynamics and understanding what FinTech offers. They offer speed, they offer customizations, they're digital natives, they don't have legacy technologies, they don't have an installed base that is incredibly complex to manage. They have an ability to serve early adopters and what can be called the early majority. So they're digital native firms serving digital native clients, if you will. So they have all these competitive advantages. The Big Tech has a slightly overlapping but overall different set of competitive advantage because they have the enormous scale of the large platforms, right? What we often call the GAFAM or GAFA here in Europe. So if you think of the very largest platforms, but the same largely being true in other parts of the world, particularly in China, of course, where there's a different set of big tech, particularly Tencent and Alibaba, but with some comparable dynamics. with Chinese characteristics, of course, but there is this enormous capacity to reach customers, to leverage some trust. We can discuss trust in big tech versus trust in banks, but there is certainly an existing basis of trust that can be used, and of course an enormous amount of data and network effects. So that's on big tech, and again, all this just as a teaser for the much more elaborate analysis in the report. If you look at banks themselves, they have some advantages and some disadvantages. In terms of technology and also of customer experience, they're actually at a disadvantage very often. Not to say that banks are not adept at embracing new technologies. They're actually typically smart adopters, but they have a legacy base, and the customer experience is not always stellar, as any of us knows, actually, as bank customers. So there is competitive pressure from people who focus on those aspects of technology and customer experience. Now, of course, they have size, they have network effects like big tech, but not the same size. I'll come back to this. And they have some policy-based advantages and disadvantages. They are regulated, but that also provides some form of preferential treatment in some areas, even so it can be viewed as a disadvantage in others, starting with the fact that they have to maintain capital. But they also have, as I mentioned before, a strong connection with the political establishment and an ability to lobby with the technological startups, even the big techs don't necessarily have an equivalent of. So that's a very broad brush view of the competitive landscape. We summarize it in this table. I will not comment it all. Again, have I said that I encourage you to read the report? Anyway, I will say that again. So let's come to the conclusions and the last chapter, which is about prospects and policy choices, which is probably what you're most interested in. And clearly, we're quite modest, actually. We're not predicting a particular future because this story is moving too fast. And even in the course of preparing the report, we had Libra coming up, we had a lot of other news coming up, even as we were, finalizing the manuscript. And it happens that Tara, in her capacity in the CPMI, is working a lot on Libra, so she knew about that. But still, I mean, there is something new every day, and we're not pretending we have knowledge of the future. What we know is, in a way, known unknowns. There are things we don't know yet precisely, which is how technologies will evolve, how banks will embrace technology, how the competition will choose to interact with the bank, for example. Of course, customer preferences is still very unclear in many areas. How sticky is the customer's commitment to the banks as opposed to embracing a newcomer. And last, but from my perspective, certainly not least, how public policy will respond. And my conclusion will be about this, because I think there are a number of essential choices that will be made inevitably by public policymakers, but haven't been made yet. And from these choices will result a lot of future outcomes. So it's not just about strategic decisions by the banks, the fintechs, the big techs. It's not just about customer choices and preferences. It's also about public policy decisions. Now, a kind of another running theme of the report is that there have been evolutions or even revolutions before, and there has been challenges to the established position of banks in the past. Online banking and challenger banks are not entirely new. We explained the example of Wingspan Bank in the report, but even if you go further back in time, money market funds were a big challenge. Much further back into the 19th century, actually, cooperative banks, savings banks, credit unions, and the like were created typically outside of the banking sector as a challenger. Now, especially in the European framework, we call them banks, and they're regulated as banks. In the US, credit unions still have a separate regulatory and supervisory framework, but initially they were challengers. So banks collectively, if not necessarily individually, have been very resilient and good at preserving their particular place in the economic architecture and financial architecture. And we expect that to a large extent to continue. There are reasons why this time might be different, including the fact that big tech are really big. I'll come back to this. But there are also reasons to believe that this will not be the disappearance of banks like the dinosaurs disappeared in a mass extinction. So these are elements of, the banks are a bit less impressive as a collective bunch as they were before the crisis. This is price-to-book ratio, and as we know, particularly in Europe, but also elsewhere, there hasn't been full recovery. All the charts, of course, are in the report. There is some indication, this is Thomas Philpon's cutting-edge research on the unit cost of finance, that after a long period of stagnation, at least in the US, financial firms are providing better value for money to their customers, but this is still very tentative. Generally speaking, the financial industry and the banking industry have not been great under at least that kind of research methodology at improving their value for money proposition, to put it very holistically. But the point I would say, putting about big tech being really big, is this. You look at the simplistic indicator of market capitalization, and you have big tech on the left-hand side and big banks on the right-hand side, and big banks really aren't that big. If you compare them to both the US big tech, Amazon, Google, Apple, Facebook, but also the Chinese big tech, especially the biggest two, Alibaba and Tencent. So there is here a magnitude of challenge in terms of new players that is indeed unprecedented. This kind of chart wasn't there in the previous episodes of banks being challenged. Now, big tech for now have not sought banking licenses in the West. They have in China. But even in China, most of their lending is actually through non-bank operations. And there's still this principle of separation of banking and commerce, which is still very formalized in the US, a bit less formalized in Europe. But in Europe, there is concerns about the US big tech, which in a way plays a similar role, which results in a reluctance to see them embracing core banking business. And of course, there are issues like open banking, data portability, GDPR in Europe, which have an impact on all these issues. And as you know, they're a fast-moving bunch of issues. So Libra has been a wake-up call on a number of those dimensions. In that sense, we think it's been very helpful to the discussion about policy, because it raises a lot of big questions in a much more immediate and bigger ways than any of the other project, including Bitcoin frenzy. Libra has gotten policymakers much more powerfully outside of their comfort zone, if you want to put it that way. So we're not predicting that Libra itself will happen or become a thing, but the discussion triggered by Libra is very significant and is about a lot of the real issues. So we detail that a bit. We also spent some time thinking about supervisory architecture and whether the global architecture is up to the task. There are pressures towards fragmentation across jurisdictions, and we've seen a lot of that in the last 10 years, including inside the Eurozone, intra-Eurozone financial fragmentation, which is or isn't solved at the current stage of banking union. But if you look at it from a global perspective, we have had this tension, which Stéphane Rottier and I had tried to analyze in a Bruegel paper 9 years ago, between the re-regulation of the system resulting from the crisis and the vision of a globally integrated financial system. And there is an inherent friction between those two. So we discussed that in the context of technology-driven business models in the report. And basically our conclusion is that policymakers should not shy away from institutional experimentation, maybe on a small scale, but should not start from the priors that any supervision that's not strictly on the basis of existing jurisdictions is impossible, because actually the lesson of European experience, both with banking union, but also with direct supervision by ESMA of some market infrastructure, for example, trade repositories. I should always say that I'm an independent non-executive director of one of the trade repositories, is proof that things that were considered impossible before the crisis in terms of supranational supervision have actually become a tangible reality now in Europe. And so if that has happened in Europe, I'm not saying the world is Europe writ large, it's not, but it's possible to think on a regional basis, maybe for some data intermediaries, of course, for example, on a global basis, to imagine some new experimentations that would make sense. So this is my last slide. I've almost made it in 20 minutes, not quite. So momentous transformation, we're still at early stage, it's difficult to be sure of anything. The disruption in our collective view is likely to fall short of the mass extinction of all banks, but still, I mean, it's a big deal, and public policy choices will be critical. Financial authorities, of course, must embrace new technologies. They should not be left behind. And this is an important organizational, operational issue for financial regulators, supervisors, and policymakers. There will obviously be different preferences in different jurisdictions, but when you think of the really big picture, we think there's a lot to say about the need for new modes of financial oversight. The one at the end of the slide is the one I just mentioned, supranational experimentation beyond what's ongoing in the EU. But there is also this very important issue that authorities that are in charge of financial stability will have to work more with complementary public authorities in areas such as competition, which is somewhat familiar in Europe with state aid control, less so in other parts of the world, but also a completely new area, which is data regulators. And we still are struggling to know what data regulation will look like in the future. In Europe, it's incipient with the implementation of GDPR. In other parts of the world, it's even at an earlier stage. But we know that probably data regulators will become a thing, and probably a big thing, in the next 10 years. And so financial authorities will have to work with data regulators. They will have to work with competition authorities, especially to understand the role of big tech. And this is something that will take them massively outside of their comfort zone, because their comfort zone is, to put it bluntly, Basel, and those people are not in Basel. So we see challenges which are operational, also cultural, and of course political in this area in terms of future policy. I'll stop there and look forward to the discussion.
Thank you so much. Thank you for that overview. When you talk about traditional finance being left behind, I have this image of a bunch of bankers standing around looking at empty shoes of everyone else who's been absorbed into the cloud. Until the rapture comes, financial or otherwise, we have quite a lot of room to discuss what's happening next. We have Tönnes Brozens from ING, and we also have Sam Tosig from Cabbage, who we met a moment ago, who will give us some brief thoughts in response to Nicolas' thoughts. We will have a little bit of back and forth on the panel, hoping to keep the answers a little bit pithy, keep things moving along, and then we will move it to your questions. The more questions you have, the better the discussion is. So while you're listening, think about your question. If you can, think about how to pose it as a question so we can get a little bit of debate and dialogue going on up here. Thanks very much. Tönnes?
Thank you. Thanks, Nicolas, for this great report and this great summary. I think Nicolas was very humble not to mention it, but it's really a report that you should read from the first page to the last page, because it's quite good.
I really should have written a leitmotif to go along with this.
Exactly. So maybe a few points to highlight. I very much agree with the point that I think that regulators should and supervisors should coordinate both more within their sector at the global level, and also beyond their own sector with other regulators, like competition and data. I found it a very defining moment, for example, when I think it was in July, when there were a number of worldwide data protection authorities that together wrote a response to Libra and said, these are the demands that we have for Libra that it should comply with. And I think this is the example of how things should move forward. Suppose in the theoretical case that you don't have time to read the report as a whole, and God forbid you only read the executive summary and the conclusion, then you will find in the conclusion, which I found very fascinating, that it first says in the conclusion, yes, banks will always be around, banks have regulatory experience, they are, well, like you said, they have a sort of symbiotic relationship with governments, so they won't go away anytime soon. But, next paragraph, they in fact may face very tough competition by big tech, so maybe things do change. So it's sort of two thoughts there. And well, I think this is a place where we all are at the moment. That it can go either way, and we are really at a point where both the actions of banks, the actions of big techs, and, as you rightly indicate, the actions of policymakers and regulators can define which scenario we will take going forward. Maybe one little footnote there. I think one question, and you already touched upon that as well, is the question: are big techs even willing to become banks? So are they willing to obtain a banking license? And first of all, I think they may not need to, because, like in China, they can basically offer most, if not all, of banking services without actually becoming a bank. And that raises all kinds of new issues, because financial supervision, both microprudential and macroprudential, is geared towards banks. And if new banking-like services are being offered not by banks but by other institutions, and that demands a response from financial supervision. But it also demands a response from a financial stability perspective, because I think we're quite not there yet in Europe, but in China it's a different matter. New streams and new exposures may develop outside the banking sector. The second reason why big techs may not want to become a bank is why would they not leave the plumbing of the financial system to the banks and take the primary customer relationship themselves, because the value is there, is in your interaction with the customer. That's where the data is, that's where you get to know the customer, and where you can build the platform, which is what the big techs are good at. And why not leave all the nitty-gritty of actually doing the transactions and actually complying with all this difficult regulation, both from a prudential perspective and KYC, AML, leave that to the banks. So I think that's a big question mark. Well, is all hope lost then for the banks? I don't think so. Yes, banks may lag behind in sheer power, in sheer financial power, in data analytics power. They may be held back by legacy technology. However, there's still time. Because indeed, people still, they may not like the banking sector, but in the end, people still trust their own bank with their money. If you ask people, would you trust a social media firm with your money, or would you trust a bank? Then most people say, I prefer my bank. And this may change over time, and I think China shows us that it may take a few years, but it may change, and new generations may make different choices. But at least banks have still time, while they still have this trust, to innovate and to change. Banks have their experience with regulation, so yes, there's time for banks still to innovate. I do think it's important from a regulatory perspective to have a level playing field of competition between banks and big techs. A few examples there. This data is becoming ever more important. We currently have PSD2, which means that if a big tech can invite their users to ask their bank to provide the data held by the bank to the big tech, but not the other way around, which puts the banks at a disadvantage there, because they cannot ask the data that big techs hold on clients. So I think one way to help establish a level playing field is to basically strive for a data sharing framework that is truly cross-sectoral and that extends to not only to big tech, but in the end maybe to all sectors. Maybe not to talk too long, a few final points. I think, maybe one final point then. I think also in light of level playing fields, innovation. I think basically the supervisory framework for fintechs and big techs is quite adequate at the moment, because they can scale up from, well, let's stay in the payments area because that's where most of stuff is happening. And they can scale up from being a payment institution to an e-money institution and then finally becoming a bank. And so that the regulatory, the licensing scheme scales up together with the fintech's activity. At the same time, when a bank wants to innovate and when a bank wants to develop the same activity that a standalone fintech does, then this activity is immediately subject to the full banking license and the full policies that a bank has to apply internally to comply with the banking license. And then the answer that you often hear is we need to move to a framework of activity-based licensing, right? Same activity, same risk, same rules. And I think your report rightly mentions, well, that may be nice, but in the end, it's not activities that fail, it's entities that fail. So there is definitely a case to keep a base form of entity-based supervision, and I see that point. However, I do make the plea of within that framework, create more room for activities that do not pose big prudential risks to a parent bank, to create more room in the regulatory regime for such an innovation to blossom and to have, well, a more temporary, easily regulatory regime. And I don't have a blueprint how you could go about this, but I think it's definitely something that we should look into, not only for the benefit of banks, but basically to the wider benefit of the European economy and building the digital single market. And you are looking at the time, so I will stop here for now. Thanks.
Thanks for that. Sam?
These are very progressive views from a bank.
Well, thank you all for coming today. My name is Sam Tassig, Head of Global Policy for Kabbage. Just some background on what Kabbage does, which may provide some additional perspective. In the United States for the past 9 years or so, Kabbage has been operating as an online small business credit platform. We will qualify a bakery, an auto mechanic, other types of small businesses like that, in about 7 to 10 minutes for a line of credit between $2,000 and $250,000. We leverage their underlying cash flow data and other non-traditional business data to understand performance in real time. And in the United States, by the end of this year, we'll have deployed about $3 billion. We're also moving into payments to compete directly with Square and PayPal and Stripe on payments acceptance in person and online, and working with other companies to create a Kabbage-branded deposits program. Abroad, we've operated in Canada, Mexico, the United Kingdom, all over the European Union, and are looking at other countries. In those markets, we work with banks, working with their underwriting models, essentially, to use machine learning and artificial intelligence to underwrite customers in real time. And we also developed programs with banks to create brand new products specific to small business credit services. And additionally, in the United States, we work with BBVA and a separate brand to bring Main Street financing in real time to small businesses as they incur different sort of cash flow needs. And so when we look at the three legs of the banking stool here, we typically agree that the future of banks is not going to represent some sort of empty carcass of institutions. I think our friends at ING should take comfort that they'll have jobs for quite a while, but those jobs will begin to look different. We do feel from the FinTech perspective, and also from the American perspective, frankly, that banks are moving more towards a utility function where FinTech firms or big tech firms will be able to rely on the rails, the regulated rails of that bank to make payments, take deposits under some sort of brand, whether it's a Kabbage brand or maybe in the future a Facebook brand, and make loans in a way that is much more productive and efficient for the customer or the consumer, and frankly is a better user experience. And so I also represent the millennial view here today, and when we look at millennial trends with technology, we're looking at an engagement platform, really. We in the United States live and die in technology world by this score called NPS. It's the Net Promoter Score. Is anybody here familiar with that? Okay, one or two hands. What the Net Promoter Score represents is basically your willingness as a consumer to refer that product or service to a friend of yours, essentially. Banks today in the United States hover around 20 to 25 NPS. To give you a little bit of perspective there, the iPhone and Apple typically hover between 80 to 95, depending on the segment of the population you ask. And that's really important. As we talk about scaling, which back to 1923, the president of the American Bankers Association said that scale is everything. When we talk about efficiency and we talk about mass markets, that NPS score is really important. So I look at this and say, a bank in the future for Kabbage or any other fintech or a big tech is going to be the regulatory base. On top of the regulatory base, I think that's where the innovative technology marketplace begins to flourish, and we have competition around the onboarding, around the ease of application, around pricing or dynamic pricing, and around the overall experience and, frankly, the customer experience that can be offered that today in many markets, including Europe, as I've talked to some people before this about opening up European bank accounts, is simply not being offered. I do want to push back and say that maybe we don't want to leave the KYC and OFAC controls and things like that to a bank. I think that if you look at, go ahead.
I'm just obsessive about acronym.
Yes, KYC, know your customer. Essentially the anti-money laundering, anti-terrorism regulations, controls, and checks to make sure that whomever is opening the account is actually the person that you think they are. We have left these.
OFAC is the Office of Foreign Assets Control. It's the U.S. Treasury's money laundering arm. Sanctions, yes. Excuse me.
We've left these regulations and controls traditionally to the financial institutions with pillars and brand names that we all know. But banks are not necessarily well suited to understand you at all. Many banks grow through acquisition, which means that their data sets are not united or uniform. Many banks do not have a holistic understanding of your transaction history and your patterns if you have multiple accounts. Banks, moreover, don't understand exactly what your digital identity looks like because you as a consumer probably only interact with your bank when you absolutely need to, not on a continual or ongoing basis. And so as we look at the ability to onboard and understand anti-money laundering risk or other sort of, know your customer risks, I think we should look at fintech firms. We should look at the big data economy. And I think Libra will pose an interesting question, maybe not the solution, but an interesting question with central bankers and other prudential regulators to say, can a non-bank safely and efficiently really tell financial services professionals whether or not you're a terrorist or a money launderer, or that you are who you say you are, when you say you are, at the time of the transaction? My belief, and Kabbage's belief, is that the technology and data-driven side of this will do that better and frankly be more inclusive for communities that have struggled with those kind of checks on the margins for a variety of reasons.
Thank you very much. We will now have just a little bit of back and forth among the panelists. If I could ask our organizers to leave everybody's mics up so that we can have a very rapid back and forth rather than having people sort of end down and wrap up, I think that'll help. And then we'll be looking forward to hearing your questions. As the cynical Gen Xer on the panel, I had so many thoughts listening to all of these things. We were just talking about the algorithm, so I'll start there. What about redlining? One thing that we've found is that algorithms can learn existing prejudices very, very quickly and enforce them even more strongly than people can. So how do you regulate around that?
Absolutely. Algorithms, it's a math problem. So you're solving for a math problem. So any regulatory solution should also solve for the math problem. Machine learning, artificial intelligence, really we like to say AI is not a real thing yet. So let's call it machine learning, and the associated algorithms. They are completely auditable because they are consistent. And so one might say, okay, fine, do we really want to subject X number of citizens to potential redlining before a regulator can catch it? And my answer to that would be, no, of course not. That's your last step. When we look at this question of kind of the future of machine learning regulation, Europe has by far and away led the pack. There's a huge AI subcommission, or whatever you guys call it here, being led by the EC to explore essentially how do we create a framework for model governance and robust testing that ensures that disparate impact and disparate treatment do not happen inside of a model output equation. And to do that, I do believe that we need clear and consistent rules of the roads and standards set both by prudential regulators and with input from industry. But at the end of the day, it should be measured on outputs. And so in the United States at least, we have spent a lot of time measuring inputs in algorithms and machine learning programs and models, which I think is basically erroneous. It's misleading, and frankly the wrong way. Any sort of data can produce a bias or produce a proxy. If you give a data science team, a mathematician, 1,000 attribute sets on a person, and by the way, your credit card company is Visa, American Express, MasterCard, Discover, et cetera. They have about 1,300 data points on you as an individual throughout the course of your...
So you're saying we're being profiled already and it's not looking great.
No. I'm saying that data is there. But if you give a data scientist 1,000 data points and say, find me some sort of bias in this, they'll absolutely be able to do it. Whether or not it's used in a specific model or transaction, I think is completely... is really completely dependent on the outcome of that transaction.
So you think the regulators should be able to look at the outputs and nag people to do a better job?
I do.
Nicola, let me ask you this. You talk a lot in your summary of y'all's report about the existing banks around the world versus the tech that's coming. You didn't touch on competition within the banks, both regionally and just in the industry. It's hard for me to see the banks all lining up on the same side if they're busy trying to undercut each other.
Yes and no. I think if you look at public policy debates, for example, you can see, for lack of a better word, lobbying coalitions of banks. If you look at the one jurisdiction where the experience is most advanced, which is obviously China, now, China is special, and I'm not saying that the rest of the world is the same, but you've seen really the banks being on one side of the debate, even as they do compete with each other, and I say that in full awareness of the specificities of the Chinese political system and market. But I think this view that there is a banking sector on the one hand, there is a disruption from big tech on the other hand, there is FinTech, which is a third party which doesn't have the scale, but is important and interesting to keep in the scope of observation because of all the advantages that Sam has summarized and that I've also touched on. I think that kind of very simplistic way of looking at the landscape actually does make sense at the current juncture. So it's simplistic, we accept that. But take any big lobbying issues or big policy issue in that space, and you will see the bank's positions being relatively homogeneous.
So looking at this report...
Some of them are more progressive than others.
Looking at this report on the website, one thing that jumped out at me was a quote, I believe, from Tara Rice saying, one of the things we saw is that the banks could make some breathing room for themselves by cutting their fees, because a lot of the interest in fintech is from people who make cross-border payments, and the fees are kind of outrageous, and they would like to find a way around that. Can you talk about fees, and particularly fees for the poor and more underbanked consumer? Because we all know that if you're rich, you can bank for free, because people love to have your money. But fintech is coming for the people who are working on a smaller scale, who are paying lots of money for wire transfers, lots of money for currency conversions. So what about those folks? And then also, what about the banks making money off them? Because the banks will say, look, interest rates are low. We got to serve our high quality customers for free. We got to make some money somehow from our riskier activities.
Yeah, I find it difficult to answer that question for the banking sector as a whole, because there are obviously big differences between continents, but also within Europe. But when you zoom into the payment systems, and especially the cross-border payment system, because there most of the disruption is going on, I think fees may be part of the problem, or part of the reason that there's opportunity for fintechs to step in and do a better job at a lower cost. But I think from a bank's perspective, it's not just about fees, and this is about the correspondent banking system basically being a slow system, a system which takes up a lot of liquidity, a system which is slowed down by opening hours across the world, a system which finds it a challenge to do AML KYC because there are many checks involved. So when you look at the payment system, and especially the cross-border payment system, it's yes, fees are part of the story there, but it's really a really story of reforming the entire infrastructure and bringing that to the 21st century.
All right. Do you guys disagree with each other on anything so far?
I think that regulators can play a larger role in making sure that certain populations that have flocked to fintech can actually access financial services in a much more equitable way. Bangladesh has about 60 some odd banks. There's also 34 licensed non-banks, and the only difference is how those non-banks can actually operate in the international currency system. But for the average Bangladeshi that's not necessarily sending lots of money abroad, they don't really care, and so they flock to these 34 non-banks because the government has opened up basically a regulatory regime that says we're going to regulate you for inter-country payments, and that's it, or we're going to regulate you for some basic deposit holding. And because of the fintechs, if you will, or the challenger banks in Bangladesh have been able to focus on those very specific activities, they've cut the fat out from the rest of the business model and have been able to compete with the 60 large banks in Bangladesh and charge incredibly low fees to hold deposits or move money inside of the country. If you have a different use case, yes, you open up to a different risk parameter as well, and I think that's still being developed. Bangladesh has asked kind of the international monetary system to ease up on some of the rules and has been working with SWIFT on that. But they have kind of the general populace in mind for that, more so, I think, than other regulators in the region have.
I think there's an interesting pattern here of authorities using the competitive pressure from fintech and possibly also from big tech in order to move the banks on something that they think the banks have to change their behavior. And you see probably that more in emerging markets than in advanced economies, or what we call advanced economies. There's a fascinating example of that in China, which we analyze in the report, which is how the Chinese authorities have encouraged the development of fund management provided by big tech. So the Yuebao fund of Alibaba, which is probably familiar with some of you, specifically as a way to force change in the way banks offer saving services. And that's been very successful in terms of pushing the industry, which is politically powerful, to change its behavior on something that the regulators thought was important.
Interesting. Questions? All right, we got one here. One here from Matthias. Do we have a mic moving around? All right, you shout, I'll repeat the question.
You would probably need a microphone for the video.
Oh, right, yes.
You should wait for it.
Thank you, and thank you in particular, Nicholas, for mentioning dinosaurs. I left American Express, where I represented them here for 10 years, exactly 25 years ago. Since when I've been running Euractiv for the last 15 years, so I've not been entirely unoccupied. But when I studied economics an even longer time ago, there was a thing called supply and demand. And you've talked a lot about increasing supply. What I don't see is much evidence, or maybe there is, but you haven't highlighted it, in terms of lower prices, better productivity, and more safety. Any comments?
All right, let's grab a second question from back row there. Stefan, can you pass that back, please? Thank you.
Thank you. Mathias de Watripon from ECARES. Well, thanks a lot for this very interesting set of interventions. One thing I wanted to ask you was, and some people were a bit, optimistic about, disease progress, technology, and so on. Now, coming more from the regulatory side, the way I would think about fintech and big tech would be like, it's like shadow banks. I know shadow banks are not always enjoying a very positive image, but it's about exploiting market inefficiencies and whatever, and bringing new things, and of course taking advantage a bit of the the regulatory framework, which is entangling the existing players. Now, from that point of view, I think looking at how the FSB is looking at shadow banks, it says, okay, let's allow them to work, but they shouldn't be an unlevel playing field. If it looks like a bank, maybe you should regulate it like a bank, and then you should also worry about the fact that they may abuse banks, because banks are indeed liquid animals, because they take advantage of central banks and so on. And then you have this possible implicit commitment of banks to go and help these other guys. So should we think of the way to regulate fintech, big tech on versus banks, like the Vickers Commission about ring fencing and the like, to make sure that externalities are not there, because otherwise maybe we should do like Admati Helvig asks them 20% equity in that division and stuff like that, or is that too conservative and not progressive enough?
All right, we'll take one third question up here. Reminder, if you can keep your questions short, we can have better answers. Not a criticism of any questions that have come, just a general comment.
Stasinopoulos, formerly with the European Commission. There is no doubt that the big tech companies have deep pockets, and also, more important, they have more access to data than any bank. So, do we have any evidence that somehow the big tech companies, that they want to get involved with banks, are involved with data intermediation, or do they have the intention to do that? And if the answer is yes, do we need somehow, that's my question, a robust, I would say, data governance framework to regulate that?
Thank you. So we have a question on specific governance is specifically financial data and financial data sharing. We have a question about customer service generally. Why don't people love their banks? Why aren't they getting lower fees and better services? And then this wonderful question about shadow banking and sort of the flip side of activity-based licensing was how I interpreted that. If people are acting like a bank, should there be limits if they're not regulated like a bank? Should they be literally cordoned off from the system so they don't jeopardize financial stability? So, Sam, we'll just move around this way.
I'll try to take a general stab that might cover all three of those questions. Bankers love to ask for this level playing field concept, and I've never really understood what that means. Will Cabbage get access to central bank windows in that case? That'd be nice. That'd be a level playing field. But joking aside, I think in the context of data governance frameworks and data protection, as you brought up earlier, yes, by all means, I think there should be a level playing field that has some maybe small use case or industry specifications for the use of data. But for the most part, if it's sensitive data, PII, whatever you want to use your term, yes, we should have clear rules of the road that are for the most part principles-based and can develop with time and technology. But the reason that I think that's important versus the rest of the playing field is the rest of the financial playing field doesn't necessarily add up to the same risk. So if I were policymaker king for a day or whatever, my ask would be regulate institutions, whether banks, non-banks, fintechs, bank partnership, bank holding companies, whatever, for the actual risk they present to the system and for the customer. And so if you're an institution that does not engage in deposit taking and has no liability from a taxpayer, you should not be held to regulatory frameworks or standards that...
I feel like I saw that movie with Lehman Brothers.
Well, that's...
I mean, they didn't take any deposits and they weren't banks.
Sure. And I would argue that what we're looking at here in FinTech is slightly different, right? We're looking at, first of all, you don't let me finish my sentence.
I thought we should have some back and forth.
No, absolutely. So what I'm asking for here is, if I don't want to be a bank, right? And I don't want to be a bank because I don't want to be held to deposit-taking standards by, in our case, the Federal Reserve, the Federal Deposit Insurance Corporation, or the Office of the Comptroller of the Currency in the United States. What I do want is a national payments and a national lending license, and I will submit as Cabbage to any sort of regulatory framework that protects the taxpayer, the economy at whole, and my specific customers from whatever risks we present. What I don't want to do is say, well, we don't know how to do that because we've never thought about it, and therefore any fintech that wants to engage in 2 of the 3 legs of the stool has to go get a license or a charter to engage in all 3, whether or not you use the 3rd or not. I think that hampers innovation, and the reason that's important, if I want to specialize in 1, 2, or 2 legs of the stool, but not 3, is the core competency piece. So to the gentleman's question about somewhat to supply and demand, banks want to serve, in our case, small business customers. In most cases, they can't below a certain dollar threshold, $500,000 for working capital loans for some larger banks, $250,000 for regional and community banks. The marginal and fixed cost of underwriting for them is far too great. Small businesses, and we only serve small businesses, will always have a demand for credit when they see a return on their investment. And banks simply today cannot offer the smaller dollar or dynamic credit products that serve that need in a time frame that is suitable for those small businesses. If we can cut out some of the, in many cases, overburdensome regulation that does not have anything to do with the business of making loans or moving or paying checks, we can begin to focus on those areas for customers and meet the actual demands or dynamic credit needs.
Nicola?
I think the exchange shows how complicated this issue is. So it's not just, there are banks and there are non-banks which are shadow banks. There's a vast multiplicity of situations. Indeed, there is a case for several types of licenses. And we have that to a certain extent in Europe because we have banking licenses and then we have investment firms. But we have a pretty broad definition of a bank. So the European definition of a bank does include Lehman. In the US, they have a different starting point where a bank is a depository institution, and then there are specialized licenses for other kinds of things, like industrial loan companies and ad hoc entities like Fannie and Freddie and things like that. So it's difficult to generalize this discussion because there is this multiplicity of starting points, there's this multiplicity of business models, some of them are leading to different kinds of systemic risks. So I think despite the frustrating nature of just saying, it's complicated, it actually doesn't lead itself to a simple black and white narrative, shadow banks bad, have to be regulated but like banks. I think it's very interesting to revisit the debate about financial stability that the financial stability community was having just before the last big crisis. So I'm thinking, 13, 14 years ago, think back to, for those of you who were born at that time, 2005, 2006, you went to a financial stability conference, what was it about? Interestingly, a lot of it was about hedge funds and private equity. And people were saying, oh my God, they're very big, they look very much like banks in many ways, they're a risk to financial stability. Look what happened. We had a crisis just afterwards. The crisis was largely about banks. In Europe, it was almost entirely about banks. Even in the US, where a number of non-bank entities, asset-backed commercial paper vehicles and the like, were a financial stability problem, ultimately it was because they were backed by the banks. Hedge funds and private equity were shock absorbers, not shock amplificators. So the financial stability community had it entirely wrong. Why is that? Maybe it has to do with cognitive biases. Maybe it has to do with bank lobbying. Wouldn't rule it out.
What about the bank sovereign link? I mean, here in Europe, you hear about hedge funds as speculators hurting our banks, not as shock absorbers.
And in Europe, I think you also have the view that, hedge funds and private equity funds tend to be Anglo-Saxons. They threaten our national champions. We don't control them because they're controlled by Yanks. So there is a mix of different considerations here. And again, I wouldn't want to be simplistic. I'm just saying, I think it's very important that the Financial Stability Board, the regulatory community, is looking at the issue of shadow banks, and there is an issue there, and we learned that with, as I said, especially investment vehicles, asset-backed commercial paper conduits. You remember the acronyms of the early phase of the crisis. But let's not forget the big picture. The last crisis was largely about banks in Europe because our financial system is largely about banks. So we shouldn't, keep our eye off the ball. Now, there was a question about data rights, and I want to say how much we're at an early stage, how much we don't have the concepts to think about data ownership, data portability, data privacy in a way that's as organized as other categories of our policy thinking. And I think all these issues are massively important, but we will look back at today in, say, 5 or 10 year times and wonder at how crude and unsophisticated our thinking about data rights was. So basically, I'm displaying my cluelessness here, but I think the issue of data regulation and data rights is one we know will become big. We know that there will be very powerful public authorities in charge of data rights and enforcement, but we don't know what form it will take yet.
And that's a great point about portability. Oh, sorry, Sam, you wanted to throw something out.
No, I was just going to add that, Europe is far more advanced in the data rights and privacy conversation than we are in the US. Some very bright person once said, explaining the European perspective on privacy to an American is like an American trying to explain the Second Amendment, the right to bear arms, to a European. It's just passing ships in the night. But I do think that there are some market and cultural...
Except if the American is Californian, right?
Yeah, well,
They're bringing public banking back, too.
That's true, and pot banking. But I think there are some very important market and cultural factors that we're leaving out from this data governance, privacy, data security debate. Different cultures view privacy and data security differently, and different consumers in those markets have different demands. When Amazon announced that they were thinking about going into healthcare and creating this joint venture with a couple other companies in the United States, I had two thoughts parallel in my mind. One of them was, ooh, that's really scary. I'm not sure that Amazon, having my health data and my Amazon purchases would be great in the long run. But at the same time, the user experience is so great, I was thinking, gosh, when can I sign up? When you look at Asian cultures, even in some cases the South American cultures, the value of personal data and the willingness to compromise is a very different economic equation in different markets for different consumers. And I don't think as a public policy body or society, we've given that enough thought in terms of how we'll value it in different parts of the world and, what importance that should bear in the debate.
In the US and the UK, you see surveys routinely where people say, God, I hate the customer service at my bank, and the only thing I hate more is the idea of changing my bank and having to fill out all the forms and everything. Tenants, ING has been one of the nimbler banks. I mean, with ING Direct, with the FinTech Village, with all the different things going on. Can you maybe take that? Maybe you could even talk about pot banking, cannabis banking. But can you pull some of these threads together and give us a different perspective?
Well, I was thinking indeed about the shadow banking, fintech versus banks, and I very much agree with what Nicholas said. It's complicated. I also think that the focus on should entities be regulated as banks, or maybe even a fintech saying don't regulate us as a bank because we aren't. I think probably in a few years' time, or I think we should frame this question differently, because we are seeing already right now that banking is being unbundled, and that's what the fintechs do. They take one item and they specialize, become very good at it, and so you see that the bank was and is an institution that offers a lot of services in one place, but that may not be the future. And so I think we really should start to focus on those activities and those entities and what risks do they pose to the financial system, what regulation, prudential, but also consumer protection, what data regulation applies to that. And you see already some of that thinking, and for example, the Bank of England has granted access to central bank money for fintechs. I believe Switzerland as well. And so you see central banks indeed pondering, well, wait a minute, this access to central bank money was something that only banks had, but maybe it's time to change that. So I think this is really the debate moving forward. But I think really, maybe we should let go of the frame, the bank as sort of the ultimate, most tightly regulated institution, but we really should look at activities individually.
We have more questions? Got one over here, and we got one from Stefan. Sorry, I should have done this the other way with the microphone.
Jack Schickler from emanates. If I could just pick up on the point you raised at the end there about the role of central banks. Mark Carney and other central bankers have raised the idea of launching their own cryptocurrency, perhaps as some kind of rival to Libra, which makes me think, as a humble bank customer, why would I bother having an account at the high street bank if I could have one at the central bank? Which would be surely more secure, and if it can all be done online, possibly as simple. So I wondered, is that what's the role of central banks in this kind of disruption? Is that a good idea to launch their own kind of cryptocurrency? How should they do it? And what kind of impact could it have on the market?
Yeah, while the microphone is traveling, I will pile on and say the ECB raised the question of, should a new currency, not just a crypto asset, be run by public, or can it be in private hands like other types of utilities? And I think that gets us to Stefan now that the mic has traveled.
Thank you. I had a bit more the same question. I was wondering, couldn't you also have a subtitle, is central bank being disrupted by fintech and big tech? If you, the opposite view, if you go to non-banks more and more, how efficient can monetary policy still be when more and more you rely on non-banks rather than on banks?
All right, central bank around. Tunis, why don't you go first?
This is a very important issue, and I think when you look at Libra, we are still discussing what is this? Is this money? Is this security? Is this an ETF? So that's one thing, and I think that also relates to the previous round of comments. And so, what is this activity? What is it exactly? How should we regulate it? But I think the monetary policy implications are a major consideration. I think one of the main reasons that central banks may not like Libra is because it calls into question their monetary sovereignty. And I think when you look closely, you see that, for example, the US, which stands to lose its reserve currency status, does not like Libra for that reason. I think the ECB, which very much likes a strong euro, may also not very much like a foreign denominated currency for that reason. But if you are in emerging markets and for your international financial transactions and you are already dependent on the dollar and your corporate sector is borrowing in dollars, well then the question, well, should I exchange dollar dependence for Libra dependence, is maybe a much more balanced question than it is from a US or a Eurozone perspective. So I'm really following this debate with much interest, because this is really about sovereignty. It's also indeed about what is the public role versus the private role in money provision, in money creation. I think in the existing system we see it's a public-private partnership, right? I mean, in most countries the payment system is mostly provided by the private sector. Most money is held at commercial banks. 80–90% of money is commercial bank money. The public role is oversight, supervision, and also providing really the basic wholesale interbank, inter-central bank infrastructure. And I think for central banks, really the question is, is this time for a rebalancing of such of these roles? And also, if the private sector can do something better, why should a central bank want to step in and do it themselves? In the end, the goal is, I think, central banks and policymakers in the end want to be in control. But to be in control, the question is, do they need to provide services themselves, or is it enough to oversee private sectors, parties providing that service?
So the central banker's fear is that Libra will become a unit of account, not so much that it'll proliferate or even at some point be a transaction method, but the unit of account issue really worries them. My concern is how they will deal with it in individual jurisdictions, which could actually lead to an exacerbation or proliferation of a fractured regulatory market for big tech or fintech, depending on what tools or mechanisms the central bankers use to squash the Libra idea. In the United States, the Federal Reserve probably will use the mixing of banking and commerce clause that they're empowered to use to say, no, Libra in its current stated proposal will not happen. What happens in Europe or the UK or other central banks in jurisdiction, I don't know, but I imagine the answer will be different and will lead to disparate issues down the road.
So I think it's very interesting how we've seen the landscape evolve in a matter of a few years, right? Not so long ago we had the Bitcoin bubble, and Bitcoin is still worth something after all, but that's no longer what people talk about. And Bitcoin was really this utopia for currencies that wouldn't be linked to any sovereign authority. And in the end, it does exist, it still has value, but it's not really a currency. So then the debate shifted with Libra to stable coins that would be regulated and authorized. And what we're seeing, and I think our two speakers summarized it quite nicely, is that authorities are hesitant to license and authorize it because of the concern for sovereignty. And I think this also extends to emerging markets ultimately, because most emerging markets want to be able to do things like imposing capital controls. And after all, the IMF is also saying that may make sense in a number of situations. And that's a big difference between having your currency pegged to the dollar versus using Libra. So I think I'm not going to venture a definitive forecast on whether Libra will happen or not, but we see this reluctance, and I think it's very natural given the issue of sovereignty and monetary policy autonomy. Now, the question that was asked by the gentleman over there was about central bank digital currencies, and here it's a slightly different set of trade-offs, because there would be no loss of sovereignty there by the public authorities. What we would lose, however, is the intermediation role of the banking sector. Because yes, the central bank can take deposits, but what will it do with those deposits? And if you want credit to be allocated with the economy, one thing we know is that central banks will not want to be in charge of the entire function of credit allocation. So you still have a missing link if you go for that kind of directions, and that's something that policymakers are keenly aware of. Now, I have to make a slightly defensive comment about this, because there is no proper discussion of this challenge in the report, because it just has accelerated so much in the last 2-3 months. Right. And that's when we were reviewing the final manuscript. So that will probably be a good issue for the next Geneva report.
Could we take this central bank hegemonic currency proposal as sort of a rebuttal to this idea that central banks would be on the Libra board and give it a stamp of approval? I mean, is this just a little bit of debating as opposed to actual policy direction?
I think you have to make an obvious distinction between a digital currency that would be linked to a particular monetary policy jurisdiction, like a country or the Eurozone, and an international digital currency as Libra ambitions to be, even global. Central bankers do a lot of things together in Basel and elsewhere, but one thing they do not do together is issue currency.
We know that the G7 was due to issue a report at the Benoit Cœuré group, I think yesterday or the day before, and got delayed. So this shows that it's a hotly debated issue among central bankers.
Right. Do we have any final questions from the audience, maybe in the back? No? Thank you so much for coming. Thank you for participating in the discussion, for being here. Thank you to our panelists, and we hope to see you again at a future Bruegel event. Thanks.